Hello, everybody. You are tuned into Non Wealth. My name is Nell.
And my name is Lebo. Today we are actually on day 3 speaking about credit. I'm sure you guys were actually excited about this whole credit part. And today we have an expert that is actually going to tell us more about credit.
I mean, credit is one of my favorite topics just before property investing, but let's get into it, man.
I'm sure most of you guys were thinking that Lebu will be the one that will be speaking about credit, but it's not me. Mr. Lebu, can you please introduce yourself?
All right. My name is Lebohang Monama. I'm a banker with just over 7 years experience in the banking industry. I'm an entrepreneur at heart. And I think the topic of credit obviously always sparks my interest, and I enjoy it the most, and also, enjoy to share this topic with quite a lot of people that are not aware of some of the semantics that, are at play, that obviously some of them end up having challenges in terms of that whole access to the credit, because obviously the backgrounds that we come from as people, some of us may not have been previously been exposed to credit, and quite key factors that really helps in terms of putting your foot on the doorstep. So I think I appreciate the time given by Non Wealth to actually share this subject with you today. I hope that you're going to obviously learn as much as you can. And if you've got any questions as well, you can pass them through. I'm more than willing to answer those questions and even engage with some of you on a one-on-one basis. So thank you.
Awesome. And I think we've already even introduced the topic itself. So let's get into it, sir. What are your thoughts about credit? When you hear credit, what comes to mind? So if you can expand on that, we'd really appreciate that.
I think if you think about it, the whole credit aspect, it's actually quite complex and it's a broad topic. But I think, we have to start with the basics. Everybody needs to understand that, with everything, obviously there's basics to everything. And with credit alike, there's those basics that ideally, if you want to understand it better, if you want to utilize credit in order to grow your wealth, and if also, you need credit in order to start, your business, you need to understand, the fundamentals of credit. And I think one of the things that I would like to discuss with you today is around, the 5 C's of credit, which number one, it's the character, which I will expand on just shortly. And then secondly, we've got capacity. And then thirdly, it's capital. And then it's collateral. And lastly, it's conditions. So we all know that, quite a lot of times when you try to get access to credit, you are either told that you do not qualify. And the reasons that you get, obviously, sometimes, to your point, from your side, you may not even understand as to why you're not making the cut, because you've got enough money in your account, or you've got more money going through your businesses, but some of it is not banked. So, it's always complex. But I think I will start, with the first aspect of the 5 C's of credit, which is more to me the fundamentals of credit. And I think if we think about the whole character part of the 5 C's, very important. Lenders, banks, financial institutions, before they lend to you, like you're not going to lend your money if you put yourself in the bank's shoes. You're not going to be lending your money to somebody that does not have some sort of financial history, that you don't understand how, they bank their money. And if they do really pay their accounts, starting from as little as a telephone bill, or it could be a clothing account. So you want to have some certain level of comfort to say this person actually in their past commitments from a credit perspective, they've been able to honor them. They don't have any adverse findings listings on credit bureau, because I think credit bureau will play a very critical role in terms of determining this part of the 5 C's, which is your character. So I think my advice is that you need to be sure that if you've got any commitments, you meet them on time, and you ensure that obviously in future, when you're trying to get access, these things are not going to come back to bite you to say, in 2010, you had a credit card which you was handed over to the lawyers, and now you're trying to actually get funds so that you can develop a property that you've seen, and unfortunately the banks are unable to lend to you. So I think that's quite critical. Other factors is your debit orders. If you think about it, if you've got a banking account, you can't have debit orders that are bouncing back, because if you made the commitment, you need to be sure that there's enough funds when that debit order goes off. Otherwise, your check account will obviously have a bad history whenever, every debit order bounces. And most of the times you even get charged if the banks, have to either honor those debit orders that have bounced, or, in certain instances, they reverse your debit order, which penalizes you. And I mean, imagine if it's an insurance debit order. What if it's not paid and you run into an accident? Your insurance cannot even be able to assist you. So I think quite critical, your character. Character speaks for itself, but I think from a credit perspective, it's mostly around how you've been able, to manage your financial commitments, your credit commitments historically. And that really plays a key determining factor in terms of banks saying, this is a character that we want to do business with, and not banks alone. A lot of financial institutions will obviously run that background check. I mean, even if you're trying to get a property to rent, these days they still look at your credit profile, which obviously determines as to, are you a reliable person that really actually, meet their commitments and obligations at the end of the month? So quite critical, and I think we can expand on that later. But I think those are the basics of it. And secondly, it's capacity. So if you're asking for money, first of all, we know the whole notion of income versus your expenditure and also other commitments that you have. So very fundamental and key is that you need to have surplus funds, obviously taking into account expenses that you have. If you're trying to borrow money, key critical, you must have an income, and you may already have expenses and maybe, other commitments. So it's very critical that ultimately, when they take your income and minus your expenses and other commitments, there's surplus funds, obviously, that you remain with. And those surplus funds then will be used to determine whether you can be able to afford the commitment that you're trying to get into. So I think that's very important as well. So you need to ensure that you're not trying to get credit, but your expenses are more than your income. You are in an overdraft position. And I think from a National Credit Act perspective as well, banks have got an obligation to adhere so that they don't lend recklessly to people that cannot, afford and qualify to actually get access to the funding. Otherwise, there's implications for the banks. If somebody was to take a bank that recklessly lent to them, to the ombudsman can rule in that person's favor, and the bank can be prejudiced. So I think quite key critical is that, you need to have a strong budget and understand the commitments that you're making. And at no point should you find yourself in a position where your expenses, combined with other commitments financially that you have, are not exceeding your income. Because in that position, we actually say, your affordability is non-evident. I mean, for me, if I lend you $50 and I'm expecting you to give it to me back, in the next month, but already you are only earning 10 rands, it becomes quite a bit of a difficult decision for me to make. So I think quite important, you need to ensure that you manage those expenses of yours, and expenses that you really are incurring and you shouldn't be incurring also. That speaks to your discipline around your budget. And I think you need to fix that so that you can find yourself in a better position financially to be able to actually take advantages of opportunities, as and when maybe you see a property that you think, I would like to invest in this. And I think the starting point, obviously, it's in the budget, but also ensuring that, you work proactively. If you're trying to buy a house, you don't wake up today and decide that I'm going to do an application. You must have already known the criteria that it takes, for you to get that lending. And by the time you even start shopping for those houses, knowing very well that you rely on the funds that comes from financial institutions, very critical that you understand upfront what you can qualify for. And, some banks are giving you pre-approvals, others are giving you pledges to say, based on the information you provided to us, a pending verification, we're able to give you a pledge of 1 million. You can go look for a property within within this price range and see if we can assist you. So very important, I think there I was speaking around the capacity part of the 5Cs. So you need to have affordability in a nutshell. I think if we simplify it, affordability is key. And really, that just means if your income minus expenses is a good positive, then that's a good starting point. So yeah, and then the third one, it's capital. Capital speaks to more around, you've got your own funds. In certain instances, if you see an investment like a property you want to invest in or a business, the banks have got a notion that we are a lending institution, so we can't take 100% of our money, put it into your dreams. What are you putting in yourself, So at some point also, you need to really put something of your own, and that gives us confidence that you're also taking as much risk as we would be taking, for instance, as a financial institution. So I think if you think about this notion, this speaks to how we say now you need to save as much of your money so that you can have also a little bit of your capital, so that in future, if you're trying to get access to funding, they can say, no, we're willing to lend to you maybe 800,000 while you're buying a 200,000 worth of a property. Then they need a deposit of 200,000. So you obviously need to put yourself in a position where you build yourself up for success, and also you save as much funds as you can. So when you make your profits and your business is doing well, or your hustle is really working for you, remember that at some point there's going to be a need for you to grow, and you may need a little bit of your own money. And also, to save for rainy days, like COVID-19 has really shown us that should, things go south, you'd still need to have a buffer and some funds on the side that can assist you. And then that is a capital that obviously I'm talking about, key factor that the banks will look at to say, what capital outlay are you sitting with on your side? Do you also have something that you want to put into this thing, or you want us to take 100% of the risk in your own business? So it's some of those factors, right? And then you look at collateral. So collateral, simply put, a lot of you refer to it as security. They will tell you that if I'm lending you money, can I have some security? Do you have a property that I can actually take on and hold on to it to say, should now not be able to pay me, we can go repossess the property and be able to actually, realize back our funds that we would have lended to you. So that really gives us confidence to say, I remember with with credit, basically, there's a lot of risks involved, from both your side as the consumer of the credit and also the financial institution that will be extending funds to you. Because should things go south, they lose their money, but also you still owe them. It's not like when things go south, they lose their money and you walk free. And there could be really implications, which I will touch on later. So very important to have that collateral. Normally, when you buy a property, the property you're buying in itself becomes collateral if the bank is financing you, or a vehicle that you're buying becomes collateral itself. So you need to know that the more properties you acquire and you pay them off, within a reasonable time, the more they remain bond-free. That gives you an opportunity in future to utilize that as collateral so that you can gain access to funding for the growth of your business and your aspirations. So that's quite key and very important. And then lastly, of the 5 C's, it's conditions. So if you think about conditions, conditions speaks to quite a number of things. We speak around the conditions, the principal debt that we're giving you. How much do you want us to lend to you? the interest rates that we're giving you, very important, because you know every rate, every percentage of a rate that you get means that you're losing more money out of your pocket. So you want to ensure that you've got a good credit profile, good credit history, so that when they start to look at the conditions of the loan as well, they can actually give you favorable terms. They can also give you favorable interest rates, which will help you, you know, to really pay as less as possible, because you do understand that buying a house is like a higher, you know, purchase. It's very expensive, and if you look at a percentage of any amount that you owe on that loan, it literally, you know, affects the cash flow that you remain with in your business. So it's quite important that you really take into account those conditions, and other of those conditions may be issues that are even not within your control, like COVID-19. If you, the business you are into, yeah, it's severely affected by COVID-19, automatically you become high risk, you know, to the lending institutions, in which they can be able to lend and extend further facilities in a form of loans, or funding for your property or your stock or whatever business that you do, because you're severely impacted by the pandemic. But it's not just the pandemic, it could be legislation, you know. Other legislations can also come to affect your business, you know, in a very terrible way. But I think ultimately you need to ensure that you mitigate the risk at every point, you know, that you encounter these things. And I think when we speak credit, you know, there's quite a number of issues that we need to take into account, because if you're taking a credit, first, it's sometimes a bit pricey, but in other instances, we go to credit because it's our only option, you know, to realize our dreams. So I want to speak about also another aspect of credit, which obviously should give you a bit of comfort, to say, if you take credit, ideally you want to pay it faster. But I mean, in most of times, credit is quite key, because especially if it's productive credit, when you take funds that don't belong to you, a borrowed advantage, and you actually loan that you've taken over a period of time. So here's one key thing. You need to ensure that as you take that credit, you are good for it, and also cover that credit, you know, cover the risk, because I think the moment we speak wealth, we also speak legacy. And it's very critical that you ensure that when you make those sacrifices of taking that loan and you're buying a property, should something, you know, unfortunate happen to you, you are also well covered in a form of, maybe you've got life policies that will cover that asset in the case that you know more, and your beneficiaries can inherit an asset that is, you know, bond free, it's not owed. And secondly, you know, you can also look at home loan protection plans, for instance, so that should something happen to you, you are disabled, or you pass on, unfortunately, your beneficiaries can inherit an asset that really is paid off in the form of the proceeds from the very same policy. It's very critical, because it will be a sad day on earth that you sacrificed so many years getting this access to funds, buying properties, and when you depart, those things are owing, and the lenders come to take them. So you want to ensure that you leave that legacy behind, and your loved ones, you know, can have assets that they can use to take care of them financially and otherwise. So yeah, look, I mean, I think those are the 5 C's of credit. Ultimately, if you actually take into account all of these factors, that's how you're going to be appraised from a credit perspective, in terms of whether can you be lended to from a banking perspective or other financial institutions. And then we take it from there. So those are the basics, fundamentals. You need to ensure that if you're buying through the business, your business is liquid to a certain extent, meaning that you know, the assets, your current assets, are more than your current liabilities. And also you need to ensure that you're solvent, in a sense that all your assets are more than your liabilities. And also that affordability, where you've got, you know, positive profits in your business, meaning that your income minus expenses gives you a positive. So that's quite critical. And I think that's literally the summary of credit. I think, if I may put it that way, that's how you summarize credit. And it's quite broad, but I guess simply put, if you take all these aspects into account, everything will just fall into place. And I think a whole lot of this, obviously, key critical factors is issues like the admin that you do in your business, because you then need a financial statements that must be orderly, so that in future, when you need that access, you can go back to that historic performance of your business and financial position of your business to present your case, to say, this is how we've been trading, this is how we've been advancing, and this is where we are, and all of that, and then you take it from there.
Yes, yes, yes. Most definitely, I truly agree with what you're saying, right? So now we're always hearing these things whereby people are saying that, you know what, I'm too old to be actually having credit, or I'm too young to be having credit. So now, what are your thoughts based on how old should one be to actually get credit?
We know that the law of South Africa, from a contracting perspective, you need to at least be 18 and above to have contractual capacity. So remember, trying to get that credit comes in a form of having to sign some agreements, and those agreements are actually essentially your contracts. So from a legal perspective, we know that only when you are 18 and above, then you've got access to signing contracts in your personal and individual capacity. So there's not really an age, but obviously we need to take into account that legal aspect of it, to say you need to be an adult and be able to have contractual capacity to actually gain access to that. And also, if you actually think about it, it doesn't matter how old you are, so you still can get access to credit at your convenience, and you just need to ensure that you are healthy from a balance sheet perspective and an income statement perspective, if I can put it that way, in your personal capacity and your business capacity. So you need to ensure that, because you'll be ultimately the shareholder, the director, you've got a positive financial health, and your business also has got a positive financial health. So I think that what really determines affect you that much if you've got a strong balance sheet.
Okay, so this is one of the questions that we'd like to ask. What is the ideal number of credit cards that one should have?
For me personally, I prefer to only take on productive debt. And by that I mean take on debt that you're going to utilize in order to generate more wealth or income. I wouldn't really, I'll take a credit card if I'm going to be using it, to finish the project that I'm busy with, which ultimately may give me some funds when I sell off. Because you also need to not, be in that credit cycle for over and over and over. Ultimately, you need to use the credit and use it to its fullest potential to be able to get slowly out of it, because ultimately you don't always want to be in a position where you're taking 100% of debt to finance your business or your dreams. So quite critical. Productive debt for me, it's quite key, because it could be debt that you're taking to buy an asset that you're going to utilize to generate more income for you. And if it's multiplying, at a fast pace, that asset that you've acquired, then you can pay off that debt within a lesser period than the one that you would have agreed with the banks, which cut you some expenditure in a form of interest. Then, because then you'd be settling within a shorter period than you agreed. So quite key. You can have as much credit as you want, as long as you are good for it, but you need to be very credit that is moving you forward, and you're also taking credit that is going to really advance your agenda from a growth perspective, financially, business-wise, and in terms of growing your balance sheet. And yeah, I guess that's key, because if you're taking credit to buy a truck that is going to be delivering water to some company or community, and you're generating income on it, that's like good to go. But if you then on the flip side take those funds and decides to go on a holiday and come back having to pay them, you're more working, backwards in a way, if I may look at it that way. But it's obviously your preference. The options are there, and you just have to make the decision yourself.
So most of our viewers are actually property investors or aspiring property investors, right? So now someone is at home right now. I can feel it in my blood. That someone is at home and saying that, you know what, I want to actually apply for a home loan, but now I'm not sure with regards to my credit score. Am I sitting on a good credit score or not? So now, what do you think is the actual good credit score to be able to actually start applying for property?
And look, I mean, the credit score, a good credit score, ideally, if you've got a score of over 600, they call it a Delphi score. If you've got a score of 600 plus, it's fairly a good score that should get you across the line. That means you don't have any legal, you don't have any adverse findings and legal effects that really are hanging on you. And you don't have any debt that you were not able to pay and you are handed over to the lawyers for collections. So there's no litigation against you. And I guess that's quite important because, like I said, remember when we started, one of the key conditions around, one of the key factors was character, which speaks to how you actually pay, your commitments. And you see, when we speak then about credit scores, all those factors then come to affect the very same credit score, which institutions will look at to say, but you're sitting on 400. And if we look at it, it could be two ways sometimes. Sometimes it's because you never really had anything on credit, and there's not enough score for you for them to generate for you. However, then you could have a low score because you had previous financial commitments that you could not, meet, and you were handed over to lawyers, and you ended up on credit bureau listed with adverse findings and defaults and all of that. Now, when you try to get access to funding, becomes very difficult for lenders to look at you favorably. And really, it will impact on the growth of your business and your aspirations, because it's not always where we've got our own cash to do these things. So yeah, I guess those are more, the fundamental factors that one should consider. But it's broad, and I'm more than willing, to engage further on this topic with each and every one of you who'd like to engage with me. I'm quite available, and I can also, share some good practices that personally I've done them. I've applied them in principle, in practice, and they've worked for me. And I'm still small in what I'm trying to do from an entrepreneur perspective, but I think I'm on the right path. I'm on the right direction of growth, and over time, I think things will get better. And from my side, I would like to say thank you to each and every one of you for listening to me, and I hope this was helpful and very informative. And if there's any other questions, like I said, you're more than willing to pose the questions, to me. You can give them to Lebo or Neo, and I can respond to them individually or whichever way you prefer me to. So yeah, thank you so much.
Okay, so now as a curveball, before we actually close up this particular meeting, right? Neo and Lebo weren't actually expecting this particular question. So you know that it's about to get down. So now, Lebo, can you please just tell us, how did you meet with Neo? It must be a really interesting one.
How did I meet with Neo?
Yes.
Okay. So look, I mean, I met Neo. We were in Maponya with my partner, and Neo actually, we called an Uber, and Neo, rocked up and gave us, a ride home. And in that conversation, actually, we started chatting, and he dropped my partner at her place and dropped me, and we started talking and I could hear that Neo has got aspirations around business, and fairly myself, it's an area of interest for me. I enjoy, small enterprises, the growth of small enterprises, and I'd really like to contribute as much as I can from my side. And we started engaging, exchanged numbers, and started speaking around business. At the time, Neo was in a transporting business, and not long after that, I could see that he was transitioning into property. And, from my engagements with him and you, Lebo, you guys are doing very well. You've really put your foot on the doorstep, and this is really going to be one of those biggest moments of your life in future. You've really made the right choice, and really that's how I came to meet, Neo, and from there on, we started chatting, and we're still chatting even today. So yeah, I think that's really how we met. So yeah, thank you so much, guys.
No, especially in the future, looking forward to the future, there is something that we did mention that this week we will be launching Non-Wealth, our business launch, and in the future we'd really like to have Mr. Lewu coming through to our events and him shedding more light. As you did here, there's so much to learn about credit, there's so much to learn about the financial institutions and towards the practicality of businesses itself. So we're looking forward to the future and can't wait, guys. I really can't wait. I'm looking forward to it, and thank you, sir. We really appreciate your time.
From my side is that you need to make sure that your credit score is good, and make sure you've learned the 5 C's about credit, and make sure that you're actually positioning yourself to a point whereby when you do apply for credit, you are sitting in a good note.
Non-Wealth signing out.